Okay. Hello, ladies and gentlemen. I hope you're fine wherever you are. It might be night, it might be morning or evening when you are watching this video, but I guess you are doing very fine. In this particular video, we're going to look at make or buy decisions. Okay, but this video is one of a series of three videos which are dedicated to the philosophy of limiting factor analysis. Okay, we are just expanding the idea of limiting factor analysis. Remember, in the previous week, we looked at throughput accounting and the theory of constraints. All right, so we are still on track, and in these three videos, I'm sure you are going to master the theory as well as to understand this um, philosophy of variable costs further. Okay, remember, all these are enshrined in marginal costing. Okay, and when we say marginal costing, we are actually referring to uh, those ideas which advocate for relevancy. Okay, that is relevant costing. Okay, what are we talking about? We are actually talking about variable costs. These are the costs which um, are instrumental for decision making. Why? Because they are under the manipulation of managers, or they are under the control of managers. Unlike fixed costs, these costs, they do change with the level of activity. Okay, fixed costs, on the other hand, they do not change with the level of activity in total, and in that respect, they are not worth to be considered for managerial decisions. Why? Because managers do not have control over them. Okay, so in short, um, the idea of variable costs is that we need to put our attention on those costs which we are able to put some degree of control over. Okay, so there are actually three videos I am dedicating. Okay, as part of your revision, you guys, before you enter into that, fearsome Acca performance management exam. All right, but I hope this time around you guys are going to pass. Okay, they're going to pass this particular examination. All right, so if you are not yet part of my school or my students, please just consider, to join others so that your passing is going to be somehow, you know, on a larger extent, guaranteed. All right, so let's go to this particular one. Make or buy decisions. Okay, these are decisions related to whether a company should manufacture in-house or buy outside. Okay, so what should be considered before a final decision is made? Number one, there should be some uh, cost analysis, and we put in brackets relevant costs. Okay, only relevant costs should be considered. And what are these costs? What are they? Okay, relevant costs are those costs which are directly linked to a particular decision, and they are futuristic. Some codes might be directly linked to the problem or decision, but they are no longer applicable, or they are considered sunk costs. Okay, they have already been incurred. So therefore, in our next meeting or our upcoming decision making scenario, they are no longer useful, all right, because they've already been incurred. Okay, so we'll talk much about relevant costing in the next video. All right, so don't worry about that. Just check on the list of videos. Uh, I mean, I'll provide the link for this next video below. Okay, now that's about relevant costing. We are simply saying that only those costs which apply or which are directly linked to this particular scenario or this problem are only going to be considered. All right, so you need to analyze those costs, and you then have to come or to arrive at a situation on whether looking at those costs, it is still profitable for the business to pursue. All right, then we go to the aspect of quality. Sometimes something could be very expensive, okay, in terms of our costs, but we then have to consider the aspect of quality. Sometimes our customers want that component to be there in our products. And even if by the end of the day, the component is going to be expensive, we are going to be forced to buy from outside rather than to manufacture it ourselves. Why? Because in terms of technological advancement, we are not yet there. So it is actually better to outsource this particular product so that we make it or we assemble it in our factory and come up with a more viable product. So quality consideration. This also applies the other way around. Sometimes to manufacture the components in-house would be preserving quality rather than outsourcing the product elsewhere. So in that case, it is better to manufacture the items by ourselves. Then there is an aspect of capacity utilization. Sometimes you might discover that if we are operating at less than full capacity, it means that it is profitable to manufacture goods in-house. Why? Because we still have more, or let me just say extra labor hours or extra office space to ensure that the manufacture of components can be done in-house. So if we still have the capacity, or if we are operating below full capacity, then it means that it is economic to manufacture the items in-house rather than to purchase them outside. Okay, so you realize that if we continue to operate under or let me just say below capacity, it means that we'll be losing out. Okay, so if we continue to forego that advantage, there is what is called an opportunity cost. Okay, an opportunity cost is that penalty which we receive or which we incur if we forego to take a certain action. Okay, for example, if there is a contract which we should enter into, for example, there is contract A that is worth $1 million of income, okay, and there is contract B that is worth $1.2 million, and we are operating at below capacity. Okay, we are operating at spare capacity rather. At spare capacity simply means that we are not at full capacity. Okay, which means if we could take A, using that spare capacity, we are going to make $1 million. Okay? But if we ignore and continue, let's say this contract B has been our contract for some time now. Okay, so this one, the contract B is guaranteed revenue. Okay, but we are operating at spare capacity or at below capacity. Then it means that we are losing out the 1 million. There is an opportunity cost of 1 million which we are incurring. Are we together? Yes. We are losing out the 1 million which could be garnered if we fully utilize the spare capacity. Okay? So in an examination, you might be asked, what was the opportunity cost? Don't make a mistake of considering this particular 1.2 million, because the 1.2 million is a contract that has already uh, been part of the business, so it is irrelevant. The only revenue that is relevant there is the 1 million. What about when we are operating at full capacity? Now, if we are operating at full capacity, what it means is that we do not have any extra hours, or we do not have um, any extra resources so that we attend to other contracts which come by. For example, if in the normal course of business, we were having contract B as our only contract in subsistence, it means we cannot take on contract A. Okay, so this means that if we want to take contract A, then it means that we have to cut or to close some of the processes linked to B, and this might attract some penalties. So what then happens? It's either we need to consider some costs to reduce the revenue from B, and that reduction is the opportunity cost. The reduction in revenue from the existing contract becomes the opportunity cost. If we allow ourselves a reduction in contract B revenue so that we get revenue of 1 million from contract A, it means that the opportunity cost is that reduction in revenue. Okay, or this reduction could be some penalty. If we are saying that no, it is better to have a penalty of maybe $300,000 from contract B, then it will be fine. Then that's okay. We already know that business B cannot go anywhere. They will wait upon us. Then the $300 is just nothing. The 300,000 is just nothing. So we can allow that to be an opportunity cost. Okay, so this is just an example, ladies and gentlemen. Let's continue. Okay, let me just clean up this space a little bit. Okay, there is now an aspect of, all right, somebody might be confused and say, are those terms similar? All right, spare capacity and excess capacity, these are just one and the same things. They're just one and the same thing. Okay, excess capacity simply means that, okay, the excess capacity simply means that we are not fully utilizing the capacity. Okay, let's say we are operating at 80%. The 20% is considered excess capacity. All right, so that's the spare capacity we are talking about. Okay. Okay. let us illustrate the difference between the two terms. Okay, let me look for a brighter pen. Okay, we have got spare capacity and excess capacity on this side. Okay, in spare capacity, we are saying that, let's say we have got a building. Okay, we are leasing out a building. In this building, we expect to get a rental income from tenants of, okay, we, the building can accommodate 100 tenants. Okay, but because of the influx of accommodation in town, I mean cheaper accommodation in town, we are only able to sell 60 rooms. So our sales are only for 60 rooms. But if things were normal, we were able to sell all the 100 rooms. But because of the low demand in our accommodation or in the accommodation sector, we are only able to sell 60 rooms. So it means that we are operating below capacity by 40 rooms. So this becomes a spare capacity. So we are going to be said to be operating at spare capacity. Now let's look at the excess capacity side. In this case, let's continue with the building. We are still leasing the building. The rooms are still 100. Okay? And because of demand, we are only going to be able to sell 60 rooms. And the 40 rooms are going to be considered excess capacity. So what is the difference here? The only difference is that in economics, excess capacity is usually demand induced, whereas spare capacity is usually linked to other factors, like, for example, machinery breakdown. So that's the difference. But by the end of the day, you would see that these are just the same concept. They're just the same concepts. All right. So that was the background, ladies and gentlemen. Let's proceed with our discussion. Let me tidy up the place a bit. Okay. There is also an aspect of time to market which you need to consider. Make or buy decisions. The time to market. Sometimes, if you have to consider the aspect of taking your products as quickly as possible to the market, then you may consider outsourcing certain components which are required in your product. Okay, because you want to make sure that the finished product arrives early into the market. All right, or if there is no hurry, then you might consider manufacturing the product yourself. What about flexibility? Here, flexibility should be based on demand anticipation and scaling. Okay, sometimes the demands might be flexible, which means you can manufacture the item yourself at your own pace. But at other times, the demand might be erratic. Sometimes it booms, and you might require as many components as possible, which you cannot, which your factory cannot manufacture in the given time. So in that case, you would want to consider buying outside. Okay. Again, buying outside is also a favorable option given the aspect of scaling. Sometimes, no matter how much you're ambitious your production manager could be, your factory cannot accommodate his ideas or ambitions, which means the only option that could be available is to outsource the product from other suppliers. Okay. Lastly, we need to consider the aspect of control. If you manufacture the commodities yourself, you have got control on the technology, on the tricks, the manufacturing tricks or competencies which are required. For example, if you look at companies like, for example, BMW or Volkswagen, all those high-end um, vehicle manufacturing companies, you would see that they consider manufacturing everything within their factory. Why? Because they don't want their core competencies to be copied by others. So this is why you end up like sacrificing to produce everything yourself. You do not want your technical know-how to be known outside. Okay, but remember there are some anti-competition legislation around the world, which means that there is also some curtailment on that aspect of strategy. But that's a discussion of another day. Okay, um, now let's look at this particular example, ladies and gentlemen, so that we conclude this topic. Stolle manufactures two products, the D and E, using the same material for each. Annual demand for the D is 9,000 units, while demand for the E is 12,000 units. Okay, so we are given demand levels here 9,000 and 12,000. The variable production cost per unit of the D is $10, that of the E is $15. Um, so these are the variable costs per unit. The D requires 3.5 kgs, that's the material, whereas the E requires 8 kilograms of raw material per unit. Supply of raw material will be limited to 87,000. So you can see that materials are a limiting factor. A subcontractor is quoted prices of $70 per unit for the D and $25 per unit for the E to supply the product. How many of each product should Stolle manufacture in order to maximize profit? So here, like I said, we are using the principles of variable costing. Marginal costing, ladies and gentlemen. So we're going to have our table here for the two products, D and E. Okay. So the variable costs for the manufacture of D was 10 and for E was 15. Okay, and what about the cost of buying the item outside? So you can see that this question is very simplified. However, in the examination, there will be a lot of figures for those fixed costs and so forth. You just have to know that fixed costs are irrelevant, and in this computation, the make or buy decisions, only variable costs apply. Okay, so you go straight away to the purchase price. Purchase, if we buy outside, purchase price, D is going for how much? The supplier is going for 17 and 25. So here you want 17, you pay 17, and here you pay 25. So what is the excess cost of buying outside? Here the excess cost will be 7. Here the excess cost will be 10. And kgs required per unit. Kgs per unit. Remember, materials are a limiting factor, so this is why we are concerned about the kgs per unit. Product D requires 3.5 kilo, and the E requires 8 per kilo. Okay, I mean 8 kilo per unit. So excess cost per kilo per kg. Here, that's $7. Remember, these are dollars. $7 over 3.5 kg, that's $2 per kilo. And here, that's how much? 10 over. Let me use my calculator. Please just give me a minute. Just a minute. Sibone ukuthi siyakhupha yini. 10 over 8, that's 1.25. Okay, so from here, from our limiting factor analysis, we go to ranking. So the ranking will help us to determine which products could be manufactured in-house and which ones require us to procure outside. So if the product has got higher excess costs, then we need to manufacture that product in-house, okay? Because to buy it outside is very expensive. So we can see here that the priority of manufacture in-house should be given to, firstly, D. Why? Because if we procure this commodity outside, it's very expensive. Why? Because there is a $2 excess cost as compared to $1.25. Okay, so it is better, it's actually better to manufacture this one in-house. So ranking here is the ranking not for the most expensive item, but ranking for the priority for in-house manufacture. Please remember this. If the excess cost is high, okay, if the excess cost of the product is higher than the rest, then that product should actually be manufactured in-house. Why? Because it costs more to buy it outside. So this is the first, and then after we exhaust manufacturing D, then we consider manufacturing E in-house. So this one should be manufactured second. Please replay this part of the video because that's where the confusion is, and that's where most guys, no matter how clever or intelligent they might look, they end up being dazzled at this stage. Okay, so let me go to the next screen. So we've done our ranking. Okay, so we go to what is called the production mix, the optimal production mix. Okay, so we are going to manufacture D first. Manufacture D first. But how many of D? We are going to be informed by the demand for D, and the demand was 9,000. So we need 9,000 units, and these require 3.5 kgs. Look in the question, please verify the question. All right, so remember our total materials. Remember, materials are the limiting factor, and they were said to be 87,500. 87,500. Okay, so 9,000 multiplied by, let me use my calculator, 9,000 multiplied by 3.5, that's 31,500. And then we then have to, as you can see, we still have a lot here. 35 less 87,500. It means there are a lot of kgs available. Okay, a lot of kgs available. And let me use my calculator here. 87,500 minus 31,500. So it means that we still have got 56,000 kgs. So therefore, we then do backward integration, which means the quantities are required of B in terms of manufacture of E should be found by going backwards. All right. Okay, so product E quantities, E quantities. We know that E requires $8 per unit. I mean 8 kgs per unit, but we have got 56,000 kgs available. So 56,000 divided by 8, it means that we have got 7,000 units which can be manufactured. However, the demand for E was 12,000. So you need to be very alert mathematically to ace these questions. Okay, so 12,000 there, that's the demand for product E. So this means that you come here and say, this means that 5,000 units, and you must put in brackets 12,000 minus 7,000. The 7,000, ladies and gentlemen, is this one. Okay, minus 7,000. Okay, should be bought outside. Okay. Okay, so this is how you are supposed to proceed with this particular question. However, somebody might ask and say, we admit that we should manufacture in-house the 9,000, okay, the 9,000 units of D. But when it comes to product E, why can't we just buy all the 12,000 units from outside? Okay, here is the trick. We come back to our initial workings. That decision should be based on the on various factors, but particularly, or the first consideration should be given to the comparison between variable cost amount and the purchase price. So, as with product A here, you can see that the variable cost was 15 and the amount or the purchase price was 25. On that only basis, it means that we can not rush the decision to buy from outside. Why? Because the variable costs were lower than the purchase price. So this is why we then need to manufacture some of the quantities in-house, because the variable costs of producing them are lower. However, because there were two products, this is why we then need to determine how many of the quantities of each of the products should be given priority. And we did this particular analysis and come and determine that the whole of D should be manufactured in-house. And after doing that, we then have to consider the manufacture of E in-house again. And we determine that only 7,000 of the units of E should be manufactured in-house. Are we together, my dear friends? Okay, let's look at this other question. A company manufactures an assembly used in the production of one of its product lines. The department in which the assembly is produced incurs fixed cost of 24,000. So these were the fixed costs. The variable costs of production are $2.55, and the assembly could be bought outside at a cost of $2.65. The current annual requirement is for 80,000 assemblies per year. Should the company continue to manufacture the assembly, or should it be purchased from the outside supplier? So for that decision, we then first and foremost determine or compare the variable costs and the purchase price. So per unit, that's $255, and the purchase cost is how much? 265. So we are having an excess of 0.10. Okay, and if we multiply this by the total units, we get $8,000. Okay, now you then have to make decision based on the 8,000 excess cost. Here is only one product. Okay, so what then comes is you then have to consider the ultimate profitability to the business. Remember, there are costs which have to be incurred in the production of the assembly. All right, so if we discontinue the production of this assembly, are we guaranteed that the fixed costs, okay, the fixed costs to be saved are going to be more than this amount? Are we together? The fixed costs, if we discontinue with this production line, are we going to save more than $8,000 of fixed costs? Why do the fixed costs matter when we are talking of variable costs? Okay, remember, there are these fixed costs to be considered. Okay, so if we close out and are not able to save the 8,000 fixed costs, then what's the big deal of closing out? So it simply means that if we cannot reduce this amount, this fixed cost, to say to below 16,000, they should be below 16,000 after we close the production line, then we can safely say that there is benefit in closing the production line. Okay, other than that, if the fixed costs are not going to change, if they are going to remain as 24,000, then the purpose of closing the line could not be established. Okay, better. But why should the fixed cost impact our decision when we say that we are only going to be concerned with a variable cost? Ladies and gentlemen, I say that variable costs are very important, yes, especially for us to determine which particular product from a series of products given, which one is better, okay? And they assist us in that regard. They were also important here to establish the relevance. Remember, they are the basis of us obtaining this 10 cents excess, okay? And then Um, if we multiply the 10 cents excess by the total number of units produced, we arrive at this particular uh, amount. Okay, the 8,000. All right. Now we then have to say, remember, for us to arrive at a profit, we need to do certain things. We need to find the variable cost, which is, we need to find what is called the contribution, which is the sales less variable cost. Okay, and we get this animal called contribution. All right. Now, but for us to arrive at the profit, we then have to deduct fixed costs, and the remainder should then become the profit. So contribution minus fixed costs should give us the profit. Now, if the costs which are going to be saved are only going to be 80,000 straight, then it means that we are at what is called the break-even point, where there is no loss or no gain. At this level, it means that our fixed costs equal the contribution. So at that level, we will be indifferent. So this is why I'm saying that we want the fixed cost to be, the fixed cost to be saved from this decision should be more than the 8,000. Okay, why? Because if they are only 8,000, if we are only going to save 8,000 of the costs, then we are at break even, which means we might say we can continue to have the normal arrangement to just continue at play. But if then the fixed costs which are going to be saved are more than 8,000, then we are starting to earn a profit from manufacturing, from purchasing outside. Okay, so what is then required on this Kanban or over this Kanban is that they should investigate whether the fixed cost of 24,000 could could be reduced if the Kanban discontinues producing in-house. Okay, if the Kanban continues to produce the items in-house, if it ceases to produce the items in-house, then the fixed cost should be expected to decrease by above 8,000. Otherwise, we won't be making any profit. Are we together? Okay, so that's the little bit of workings. Remember, this costing is not a subject for number crunching only. Okay, so one more thing I want to point out on this particular example is that if we are buying outside, it means we won't be worried about the fixed costs. Rather, we're only worried about the purchase price. Okay? But if we are going to manufacture the items in-house, then it means that we also have to be worried about the fixed cost associated with that production. Okay, so this is why by the end of the day, we then have to consider the aspect of fixed cost reduction. Okay, so if we buy the items outside, we determine that the excess cost was going to be 10 cents per unit, okay, which gives us a total of $8,000. All right, so the decision on whether to purchase outside should only be viable if by the end of the day our fixed costs, which we already incur right now. Currently we are incurring them because we are having the assembly item being manufactured in-house. So there is need for an analysis to determine if those fixed costs are going to be avoided. Otherwise, if they are not going to be avoided, then there is no point in buying the item outside. There is no that justification. Why? Because the fixed costs are still going to be incurred. So there is that analysis to be considered. I'm sure I've clarified that aspect. Okay, this particular question should, sum up the concept, and we call it a day. So please read the question on the screen. Okay, Makasa Limited manufactures 3 components used in its finished product. The component workshop is currently unable to meet the demand for components, and the possibility of subcontracting part of the requirement is being investigated on the basis of the following data. We've got 3 components, A, B, and C. All right, and the variable cost of production for each component is given. Outside purchase price is as given again. So the examiner has actually done the usual analysis for us. Okay, so we should be thankful for that. All right, so the excess cost per unit is as given. We're also given the machine hours per unit and labor hours per unit. Okay, so in this case, we're given 2 constraints. Then required A, decide which component should be bought from outside if the command is operating at full capacity. So in this case, if the command is operating at full capacity, it means that it cannot assume, it cannot assume production for further units outside its normal production hours. Okay, so given the items or given the components there, you can then ask yourself which of the components has got the highest variable cost over the purchase price. Okay, so if we look at component A, you can see that its variable cost of production is higher than the amount of purchasing the items outside. But the rest here, this one is lower, this one is lower than the purchase price, the outside purchase price. So on that basis, component A should be bought from outside. Okay, why? Because the variable cost of production, this is production in-house. Okay, variable cost of production is higher than the amount payable if we purchase the items from outside. So in that case, we should then consider buying the items outside. So component A is automatically purchased outside. That's the answer for part A. Why? Because we are operating at full capacity. We cannot make any tricks to ensure that we meet the production of this particular component. We are already fully occupied. We can't accommodate any new technique or any new tricks to ensure that that component is manufactured in-house. Okay, I'm sure we are together. Then B, decide which component should be bought from outside if production is limited to 4,000 machine hours per week. Decide, and then C, decide which component should be bought from outside if production is limited to 4,000 labor hours per week. So we are going to do, okay, I'm going to do the B part, and you just have to try the C part on your own, but you'll be just using the same technique. Okay, remember that the hours and the labor, they are given here. All right, so you just have to follow what I did so that you ensure that you have learned something. If you do not practice, obviously you're not going to pass this paper, I bet, with my salary. Okay, so you need to be able, you need to be very serious. You need to put yourself to task to ensure that you do the practice um, as many times as possible. All right, so let's move on to the answer sheet. Okay, so we've got components, sorry, it's now B and component C. Why? Because A has been ruled out. A, regardless of any limiting factor to be considered, A should be bought outside. Why? Because its variable cost is higher than the amount, than the purchase price of the component. Okay, so outright, component A should be bought outside. Okay, now let's proceed with the B and C components. So we start with our excess cost as given in the question by the examiner. The examiner has been very generous. So we have got $2 for B and $6 for C. So we say $, $2, $6. We verify, yes, we are correct. And we then have to ask ourselves, how much was the kg per unit? Or yes, I mean, this in this case, I'm going to do the part B, which is we are looking at the machine hours per unit. So for B, that's 0.5, for C, that's 2. So 0.5 hours, and here we are looking at 2. These are machine hours. Okay, so excess costs per machine hour. We can see here that 2 over 0.5 comes to $4, and here comes to $3. Okay, so which of the two components should be given priority of manufacture? Pause the video before you answer. Obviously, so you just have to do our ranking, and in brackets, just tell yourself priority of manufacture. The priority of manufacture should be given to this guy with the highest excess cost per limiting factor, and this one should be considered second. All right, so this means that component B should be given the priority of in-house manufacture, okay, over C, and C should be bought outside. I mean, after considering which means the remaining should then be considered. The remaining components to meet the demand for C should then be considered for outside purchase. All right. So if there are constraints in terms of machine hours, excuse me, then we need to manufacture B first and then C last, which means if there is excess demand for C, then that excess should then be considered for outside purchase. But we should consider that after manufacturing B in-house, because if we buy B from outside, there is going to be greater loss on our part. Okay, but there is a proof. Let us prove this. Okay, let us prove this. So we come here and say proof. Okay, so units to be produced how many hours are we looking at? Sorry. Okay, we're looking at 4,000 hours, 4,000 machine hours. So units to be produced in 4,000 hours. Okay, we then ask ourselves this component B and this is component C. Component B requires how many hours? Component B requires 0.5 machine hours per unit, whereas this one requires 2 hours per machine hour. So we then say for B that there are 4,000 hours available, but we require 0.5 hours per unit. So which means here we can produce 8,000. But for C, we have got 4,000 hours available, but we need 2 hours per unit. So therefore, we can manufacture how many units for C? That's 2,000. Are we together, ladies and gentlemen? Okay, then given this information, we then come here and say variable cost or cost of production in-house to produce 8,000 units for B. Okay, for B, that's 8,000 multiplied by the variable cost of production. The variable costs were $4 per unit. Okay, so multiplied by 4 is $4. Then it means that B requires 32,000. What about C? C requires how many units? 2,000 unit. Yes, 2,000 units multiplied by the variable cost of production. The costs were $7. So it means that the variable cost of production for C are 14,000. Okay, now that dollar sign on top there is confusing other people. Okay, it almost confused me again. Okay, these ones we are talking of units here. These ones are units to be produced, and these ones are now the amounts. Okay, so we started with the variable costs of production. Now let's consider the purchase costs from outside. So we do the same for B. For B, we know that 8,000 units have to be produced, multiplied by the purchase price. The purchase price is given. The purchase price for B was 6, for C was 13. So we come here and say 8 by 6, that's 48,000. And for C, that's 2,000 units multiplied by 13. So here that's 26,000. So we total up. Do we have to total up or to subtract? I want the clever students just pause the video and answer this question. Okay, let me change the pen here to blue. Okay, so this means that the excess purchase cost would be So we separate here. So that's 32 minus 48. This should give us how much here? Let me use my calculator. Um, that's 16,000 here. What about 14 minus 26? That gives us 12,000. So here is 12,000. So if you're looking at this, which one can you say that this one is expensive in terms of excess purchase cost? You can see that this one is very expensive to be purchased than this one. Okay, so we need to manufacture in-house B and then purchase outside the components for C. However, we then do that after considering our ranking as per the available resources. Okay, as in this case, if only 4,000 hours are available for machine hours, then it means that we need to purchase these components, all of them. Okay, because we are told that only 4,000 hours of machine hours are available. Then, therefore, we need to purchase the components for C, all the 2,000 units from outside. Okay, so ladies and gentlemen, this was all from me to you. Okay, and I say that you then need to do the part C on your own. Okay, just have to follow the stages, everything I've done, and until you reach to the answer. So let us meet one another in the next video on relevant costing. Okay, because that's something we are going to look at. All right.